Marcus was 27, working in IT, and had been watching finance videos for 6 months. He had $3,000 saved up and was convinced he'd found a shortcut to growing it fast. Options trading. He'd seen the Reddit posts. He'd watched the highlight reels. He was ready, or so he thought. What happened next cost him nearly everything he put in. Today, we're going to walk through exactly what Marcus wished he'd known before placing that first trade, so you don't make the same mistakes. Let's start from the beginning, because this is where Marcus skipped ahead too fast. An options contract gives you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. There are two types: calls and puts. A call gives you the right to buy shares at a set price, so you profit if the stock rises. A put gives you the right to sell shares, so you profit if the stock falls. Here's the critical detail Marcus missed. Every single options contract controls 100 shares. That's what makes them powerful and dangerous at the same time. Marcus had heard the words, but he didn't really understand them. So, let's lock these in. The strike price is the agreed-upon price at which you can buy or sell the stock. It's locked in when you buy the contract. The expiration date is your deadline. After this date, the contract is worthless if unused. The premium is what you actually pay for the contract itself, and this is what you can lose entirely. Finally, in the money means the stock has moved in your favor. Out of the money means it hasn't, yet or possibly ever. These four terms are your foundation. Everything else in options trading builds on them. Here's exactly what Marcus did. He bought 3 call contracts on a tech stock priced at $120. The strike price was $125. He paid $1 per share in premium. That's $300 total, since each contract controls 100 shares. He needed the stock to rise above $125 before expiration to profit. The stock moved, it went up to $123, but it never hit $125. The expiration date arrived. The contracts expired worthless. Marcus lost his entire $300 premium. The stock did go up. He was just wrong about how much and how fast. That's the brutal reality of options. Being directionally right isn't always enough. This chart shows why options are so compelling and so dangerous. Look at the potential return comparison. A stock investor who bought 10 shares of a $120 stock and saw it rise to $135 would gain about 12.5%. But an options trader who bought a call with the same capital could theoretically see gains of 200% or more, or lose 100% of their investment if the trade doesn't work out in time. This asymmetry is what draws people in. But Marcus didn't focus on the loss side of that chart. Remember, all investments carry risk, and options can move to zero faster than almost any other instrument. Here's the number that would have stopped Marcus in his tracks, if only he'd seen it first. According to historical data from the Chicago Board Options Exchange, approximately 75% of options held to expiration expire worthless. That means 3 out of every 4 contracts lose the buyer their full premium. Now, experienced traders know this, and they have strategies to manage it. But for a beginner, buying short-dated, out-of-the-money calls, hoping for a quick gain? This statistic is a warning. It's not meant to scare you away. It's meant to make sure you go in with your eyes open. This is the chart that changed everything for Marcus, once he finally went back to study. Options are priced not just on where a stock is today, but how much it's expected to move. This is called implied volatility. When volatility is high, premiums are expensive. When volatility is low, premiums are cheaper. This chart shows the VIX, the market's fear index, against average options premium costs over recent years. Notice how premiums spike during market stress events like 2020 and late 2022. Marcus had been buying contracts during a high volatility period, meaning he was overpaying for premiums that needed massive moves to become profitable. After his loss, Marcus didn't quit. He studied, and he discovered that not all option strategies are equal in risk. A covered call, for example, is considered one of the most conservative option strategies. You already own 100 shares, and you sell someone else the right to buy them from you at a higher price, collecting premium income. A cash-secured put lets you get paid premium while waiting to buy a stock you already wanted at a lower price. These aren't get-rich-quick plays, they're income and risk management tools. And before Marcus tried any of them with real money, he spent 60 days paper trading, simulating trades without real capital. That practice saved him from several more costly mistakes. Marcus eventually became a confident, cautious options trader, but he gave us 4 rules he wishes he'd followed from day one. First, know your vocabulary cold: strike price, premium, expiration, and moneyness. Second, calculate your maximum possible loss before you enter any trade. With options, that's almost always the entire premium paid. Third, start with just one contract, not 10. 1. Get familiar with how the price moves. Fourth, use a broker platform that has built-in education. Many major brokers require you to pass an options knowledge quiz before you can even place a trade, and that requirement exists for good reason. This is for educational purposes only. Please consult a licensed financial advisor before trading options. Here's something Marcus also learned. Options aren't a replacement for investing. They're a tool, and for most people, a secondary one at that. While he was chasing options plays, a coworker had quietly been putting $200 a month into a broad index fund for 5 years. No stress, no expiration dates, no premiums evaporating overnight. According to historical averages, $10,000 invested in the S&P 500 index grows to approximately $127,000 over 20 years, without picking stocks, timing markets, or understanding implied volatility. Options can complement a solid investment foundation, but they should never replace it. Build the base first. Marcus lost $300, then he spent 3 months learning properly. Today, he uses covered calls on stocks he already owns, generating small, steady income without betting everything on a single move. His core portfolio is still built around index funds. Options are just one tool in a bigger strategy. Here's what to take away. Understand the mechanics before you put in $1. Know your maximum loss before every trade. Watch volatility. It affects what you pay. And paper trade first. If you found this breakdown useful, hit subscribe. We publish data-driven finance education every week on US Wealth Logic. More knowledge, smarter decisions, better outcomes. That's the goal. Everything in this video is for educational purposes only and does not constitute financial advice. Options trading involves substantial risk and is not appropriate for all investors. Please consult a licensed financial professional before making any investment.